you reward people for finding great assets, and when they buy great assets and they turn out great, you kind of reward that person, right? The irony of the whole thing is there is an investment manager in your firm that turned down 2 or 3 properties that were bad investments, and you never reward that person for not doing those investments, which they should be rewarded. They should get some kind of a bonus for finding this great property, and then they found out it wasn't so great, and we were almost going to buy it, but we didn't buy it because one person told us, oh, we found this. You forget about that lady or that dude that found that, and you don't really give them a year-end bonus for that work. But the person who found a great property and we bought it and it turned out great, at the end of the year you go, oh, we're going to give you a bonus because you did so good. Does that make sense? So the irony of it is, it's the ones you don't do are the real treasures, the ones you know not to do for these reasons, and you didn't do them, is the real, I shouldn't say the real, but one of the mechanisms or one of the components of running a great fund. Try to align everyone in your firm for the success of the firm, the investors, the fund. If you can do that, then everyone pulls in the right direction. All funds should reward employees with an employee pool inside of the general partnership, so that when the fund does well and the general partnerships gets a big chunk of cash, there should be an employee pool that just goes to employees. And I think all funds that have an employee pool inside their general partnership that is only for employees, and it's already written out kind of, then that aligns your employees with the success of the fund, which means you're aligning your employees with the success of your investors, which aligns your employees with the success of your debt investors, your banks, which aligns your employees with the success of the general partner, who are the owners of the company. So alignment, again, back to alignment, I believe that's the success formula. If you can, try to align everyone in your firm for the success of the firm, the investors, the fund. So I run my life on probabilities, not on predictions, because I don't believe anyone can predict. So 1999 came around, the dot-com bubble, where everyone was throwing money into all the internet stocks. I totally missed it. I knew it was happening. It was another 10-year boom. I just didn't know how to take advantage of it. And I totally missed it. And I said, I'm not going to miss the next one, right? And so when 2008 and 9 came around, about 10 years later, the Great Recession came, and me and my partners nailed it. We started that third fund buying properties from banks that were foreclosed on. We started buying, and we nailed it well. So you had the great pandemic, okay? And right about that time, there was a new change in the tax law called an opportunity zone real estate investment. Basically, it was this. There was a tax incentive for American investors, US investors, to invest in parts of the country that were blighted, which were forgotten, which were run down. And there were over 6,500, maybe 6,700 physical locations in the United States of America that if you started a business or built a building in that geographic area called an opportunity zone, you would get special tax benefits. And so understanding my partners, who I didn't understand this, my partners who are tax and legal people understood the opportunity here that millions and millions and millions of dollars of people would love to invest into blighted areas in the United States of America, lower income areas, and build a building, build an apartment, build something, build a strip mall or a company, and they would get great tax benefits. That was called opportunity zones, and that's why we took advantage of that boom and we started opportunity zone type funds, because one, the tax law changed, the tax incentive changed, the market was prime for it, and our investors were asking for it, and we were in real estate. So we were kind of in the right place at the right time in that 10-year boom, 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 boom. It did a boom, and we just filled that opportunity, and that's what an opportunity zone basically is. Yeah, I was about to retire, and my partner said we're going to go public next year. This is the end of 2020. And I was like, well, I'm going to stick around because I'm not going to retire because when any kid goes through college and they go through business school, when they graduate, they're like, if one day I could be a part of a company that went public on an IPO on New York Stock Exchange, you want to do that. So we were getting my replacement. We hadn't found my replacements yet for the people who've taken over my jobs, and we're almost there. And so when we went public on the New York Stock Exchange, it's you don't go public again because you just want X. You really go public because your company has a business plan, and they need larger access to larger amounts of capital. That's what it is. And it takes a lot to get there. There's a lot of scrutiny. There's more audits. There's more requirements. There's more hurdles. There's more everything to get there to qualify that the New York Stock Exchange will allow you to go public on their stock exchange. And the New York Stock Exchange is the granddaddy of all stock exchanges. So there's hurdle after hurdle. So just to qualify to go there is one deal, right? But once you qualify, it doesn't mean you should go public. You qualified, but why do you need to go public? We needed to go public because our company was doing great, and we needed access to larger amounts of capital to fulfill our larger vision of our company. And that's the reason you go public. Any other reason is kind of second place to that. I believe that's the main reason to do it. Access to larger amounts of capital and cheaper rates of capital. You can borrow cheaper because you're an stock exchange. You can borrow massive more amounts of money because you've got through that scrutiny of what it takes to be on the New York Stock Exchange. So let me go back to years ago before we started having institutions come in to give us money. In our third fund, like I said, my first fund was 2004, and my partners and I didn't get the first institution until 6 years later, about 2010. Okay, so I remember having an argument with my partners early on, and we had an accounting firm in town. They were about a 50-person team, and they were a good-sized accounting department, a firm, and we were paying them X amount of dollars to do our third-party audits for our fund. And my partner, that way smarter in finance than I could ever be, came in. He said, we have to go to the big three accounting firms to have them do our accounting. And I argued, they're like 3 times more money. We're gonna pay 3 times more money for the same. These people who are doing the accounting right now, the third-party audits, they're doing fine. And my partner, who was right and I was wrong, said to me, John, one day when we get an institution that flies into town, they're going to want to know who our accounting firm is that does our third-party audits. And if we give them a local firm, we don't pass that check on their scrutiny list. They still might invest with us, but you don't want anyone not checking boxes. But if you have one of the big 3 firms, which are triple in price, then they will check it, and then they will go on to their next scrutiny thing. And so I argued. I lost the argument. We as a team decided we were going to go with the big 3. And we started paying more money for those third-party audits. And sure enough, he was right, I was wrong. They flew in years later to our town, did the scrutiny, and found out our top 3, our people who are doing our taxes and people who are doing our audits were one of the big 3 accounting firms. And they just went check, check. And that's how we got to the big money. That's the type of scrutiny. So what I'm trying to say is we had to walk and talk and act like a institutional worthy fund before we were an institutional worthy fund. We couldn't wait until a big firm wanted to fly into town and say to them, okay, from now on, we're going to change our accounting and we're only going to use the big 3. No, we had to pay for the big 3 and we had to pay the dues before we even had the chance. So it's back to baseball, right? You gotta swing the bat thousands and thousands of times, 10,000 hours to play in the major leagues. Because you can't learn how to bat once you get to the major leagues. You have to know how to bat before you get there. We had to know how to run a public company years before we were a public company. We didn't want to go public, then become a public company. We wanted to be a public company with SOC 2 type 2 audits with, I can't remember all the things we had to go through. We had to do those things for years before to practice that when we went public, it was like we'd already been there in the end zone. It wasn't our first time in the end zone with a touchdown. We had been there over and over and over and over again. It was just a different game on the New York Stock Exchange. We had already been doing all this stuff for a few years. And I remember investors coming in a year before our going public, they were asking us, "You're a private equity fund. Why are you doing SOC 2 audits?" Well, we just want to be the tip of the spear. We want to be the elite in the industry, right? We were doing things we didn't have to do. We were paying things we were paying for things we did not have to do. But we knew we needed to do them to go to the next level, and we needed to do them first before we went there. And that's the type of attitude I believe you have to go on to each level on the way up. And that's how to attract institutional investors. You have to be an institutional grade a couple of years before you would get your first institutional investor, not when you get it. If you want to start a fund, don't ever believe you're going to start a fund by walking to your attorney and asking your attorney to explain what an accredited investor is to you. You have to know all these things, and then your attorney is going to fine-tune it of what kind of funds you want. Set a goal and become the best fund manager, the skill sets, before you launch your fund. Don't launch a fund and then become, build the skill sets first. If you want to buy biotech companies, be the best biotech company fund manager you can be, and use your skill sets. But you got to understand how a fund works. What you don't want to do. This is what you don't want to do. Let me answer the question opposite. You want to start a fund. The last thing you want to do is go into your attorney's office that does fund documents, the PPM LPA, and say to your attorney, "Oh, can you explain to me what an accredited investor is?" That attorney, making $400 an hour, would be happy to spend a whole hour teaching you what an accredited investor is. This is going to be the most expensive lessons of your life. What I'm saying to you is, you want to walk into your attorney's office and you want to tell them what kind of fund you want. Attorney, I want a fund that only allows accredited investors. I want a fund that can advertise like a Reg D, Form D, 506C, maybe a 3C1, under that type of exemptions. I want a fund that does American waterfall, not a European waterfall. Now, what you're doing here, you're telling the attorney what type of fund you want, as opposed to allowing your attorney to teach you with thousands of hours what the basics of a fund is. When I started my first fund in 1999, I wanted to start my first fund, there were no YouTube. There was no workbook. There was no great fund manager that would teach you what type of fund to do, how funds work. I had to learn it all myself. But now we have YouTube, we have classes, we have people out there that can teach you exactly how a fund works, so that when you walk into your attorney's office, you tell them what type of fund you want. They don't tell you. And that's my best piece of advice if you want to be a fund manager. I wish I knew how to start a fund earlier. I've pushed my boys in. My boys have started funds in their 20s and 30 years, the 30 years old, 20 years old. And I didn't start my first fund until I was 40. And I wish I would have known about funds earlier in life. So that's why I kind of nudge my sons into the fund world. Because I believe at one point in their life, my sons, and I will do this to my grandkids too, they're going to know how to do something, how to make money doing something. That's great. They're going to make money something. But at some point in their career, they're going to want to know how to scale it, how to duplicate it, how to make it bigger and make it work. And I believe the fund model, the general partnership, limited partnership model, which I did for you earlier on this piece of paper, limited partnership model, is the best model on the planet, and definitely the best model in the United States of America, so that you can, as a general partner, raise billions of dollars and expand your company and never get voted out like Steve Jobs got voted out of his company because it was an Inc. And Incs, what they do once a year, the shareholders vote who runs the company. In a general partnership, limited partnership structure, the money, the investors never vote the general partner out of office unless the general partner commits fraud. And so this is the structure that I believe for entrepreneurs, if they want to expand something, they want to scale it, it's the easiest thing in the world to do under this structure. It's hard under other structures. You can still do it. But this is a great, great system for scaling a business. And I believe my sons, my grandkids, and I'm a testament to that. After starting 14 businesses, my last one, starting funds, was the easiest thing to scale. All the other ones were hard to scale. They always just couldn't get bigger. They got to a certain size and they couldn't get bigger. And a fund was just like, it naturally got bigger. It just did. And that's what I would tell myself if I could go way back in time, learn about funds, learn about scaling. And that's what I would tell myself if I could go back when I was 20 years old.